Thank you very much, Paul. A very kind introduction, and I think you've got to start a talk like this by just thanking the people who've put this event together. Paul, Sharon, Nick over in the corner, and they have a large team who I've got to know over probably, I think it's 12 years now. Bit shameful that I can't remember exactly when I first came here, but this event has been getting bigger and bigger, and I think it's fantastic that it's continued to attract and retain people who want to come and listen. And it's been so pleasing to be invited to be a part of that. So thank you to them, but thank you to all of you for making this such a fantastic event. It really is the highlight of the calendar for me. It gives me a lot of people to talk to every year, so pleasing to be here. I'm not going to run you through the disclaimer like Grady would. The only disclaimer I've got to say is they handed out an intelligence test last night and I haven't figured out how to get out of it yet, so it's a bit like a Chinese finger trap. Had a shower with that on this morning. I've made the analogy of Cinderella and the ball finishing at midnight, her pumpkin coach turning back into a pumpkin and the footman turning back into rats and everything else, and everything ends as a bit of a disaster for Cinderella, which is an analogy for the top of the market. I'm not going to talk about that today because that is not relevant at the moment in any way. It's something to think about for 5, 6, 7 years' time. What nobody ever talks about is what time Cinderella arrived at the ball. And that's what I want to be talking about today, because the ball is starting. And the easiest way to talk about this and introduce it is really to slip on the Captain Obvious hat and say, there's a stimulus, right? And this is a bit like Cinderella getting to the ball and they go, Cinderella, would you like a drink? But it's not, would you like a beer? It's not even, would you like a largish glass of champagne? It's, Cinderella, here's a bottle of tequila. Because this ball is happening, right? This is all starting to happen. We've heard a lot of people talking over the past day or so, and there's very much a sense of a build-up here. I've spoken to a lot of investors who are rotating money out of one thing and going into another. They're changing industry with some of their money. I'm seeing that across the market at the moment. And this is driven, at the moment, by one thing. That's the pinnacle, the focus, and this is changing the way that people feel about the sector, which we're all here to talk about. So that's why I think it's crucially important, because I think it's aligning with a turning point, the start of the party. To talk about gold, there's all sorts of charts you could pick, and this has been making headlines, central bank buying of gold. So I wanted to start with a chart that shows what central bank buying looks like. This is monthly central bank buying or selling going back to 2002. And you'd notice that in the noughties, there was a lot of central bank selling. And interestingly, when you overprint the gold price on that, most of the selling that took place in the first 10 years of this chart was Western central banks selling out. They dumped a hell of a lot of gold. And that was purchased largely by the gold industry, which had hedged themselves to death and needed a heap of ounces to get themselves out of the balance sheet issues that they were in. So that was an interesting gold cycle. Bears very, very little resemblance to today. The thing is, the headline, central banks are buying gold, doesn't really line up. The pattern of purchasing doesn't line up with what the gold price has done. You can see massive gold selling on the left-hand side, gold price goes up. You can see gold price buying through 2/3 of the chart. Gold price is equivocal, up, down, sideways, and then up again. So clearly it's not that aggregate pattern which drives it. If I pick out when the Chinese central bank had been buying gold, and this I think is important, although it's not the sole driver, there are periods of time there where the Chinese central bank was probably half-ish of the aggregate central bank overall purchasing demand. And I think that is significant. But again, this isn't a headline which has only just happened in the last year. This is something which stretches back halfway through the chart. So there was large purchases of gold occurring by the Chinese central bank in the mid-2010s. And there's been periods of it. The thing is, what I take from this chart is these are significant purchases. They don't come to the market and buy a tiny bit. They do enough to make headlines, and in the last 2 or 3 years, those headlines, I think, have been starting to draw people's attention to this space. So that's why Chinese central bank buying is important. Not because they've been doing it all along, but because they've been doing it recently. And if you cast your mind back, you can see, holy crap, this is a trend that's been going on for some time. We constantly underestimate what Chinese commodity interest is, and this is not the first time it's happened. It's happening in gold now. So if I wipe off central bank buying and move from Eastern markets, Chinese buying, to largely Western markets, ETF buying. Exchange-traded funds are also a major, I suppose you'd say, demand driver for gold. And this pattern of buying or selling by ETFs does more closely match the pattern of the gold price. And what I would take from this is that there is a point in this gold price chart where Western markets, which had not been paying attention even 12 months ago to the gold price trend, will wake up. And perhaps they are. This could be explained in many, many ways, but when you see investors investing via ETFs to purchase gold, and that is correlating with the price going up, and we've got Chinese buying on top of that in ETFs, significant. So, gold price is going up. There's a little bit of a hint there about how it's happening, but probably the best chart that I can show you that I think applies to gold at the moment, it's not my chart, it's by Jan, long last name, knows a lot about gold. What he's plotting here is the proportion of global foreign exchange reserves which are made up by various currencies and gold. And crucially, gold has breached a threshold which it hasn't been at since the 1990s. The proportion of gold which is being held by global central banks is increasing, and you can see that in the past that has been a very, very high level. Now, you can also see the US dollar hegemony plotting out on this chart, because from the 1950s and end of World War II onwards, the US dollar gained huge traction in the global market. Gold is moving up, and what I think a lot of people would agree with is that the conspiracy of moving away from US dollars into gold is playing out into mainstream now. So, good for gold. Whilst we're on commodities, though, I think we need to talk about something which is not a precious metal and a store of value. So I wanted to talk about a consumable one, and there's evidence here of the kind of creativity and articulation that occurs at about 11:30 at night when you're putting the finishing touches on a slide. So what's copper? There's all sorts of things you could say. Maybe it's the most needed commodity ever. It's got one foot in both camps, right? It's in the new world. It's in the old world. It contributes to AI. It goes into power lines. All of those things are important, right? So this is copper going back to 1971. What jumps out at me from this chart is there are 3 periods. And in those 3 periods, copper struggled to break out above a point. Now, that point probably ekes up over time within circa 2 decades. And where we are now, we sit about 13% below in the copper spot price, the all-time high, which has been something that copper has bumped up against in the last 20 years. It's done that at least 2 episodes on this circa 60-year chart. So I just think that's fascinating, right? Gold doesn't do that. When gold goes up, it's because of a desire of ownership, and it's not limited by price. Copper is. If someone wants to purchase copper because they want to install it in a power line, they're limited by what the owner of the power line is prepared to pay for the copper. So price goes up, the purchaser of copper goes, right, I need some copper. Oh, geez, it's a bit expensive. I'll just rely on stockpiles for a bit. Copper price drifts back down, they start purchasing again. So there is pain evident in this, but it can only build up for so long. And we've seen these periods of circa 20 years. I'm not applying any real maths to the 20 years. It's just in 20 years, it gives time for a new buyer to come along. And where we see that last breakout, where the copper price roof, if you like, went up by 3.5 times, was when China became the major purchaser of commodities. So I cast my mind forward and think, well, you know, what is the new China as a demand force in the commodity market, which applies itself to many, many commodities, but copper is the big one. AI, the new world, electrification, decarbonisation, etc. Copper is majorly hinged to that. And this will drag a lot of other commodities with it, right? Because you can't put up copper power lines without steel pylons, etc. So, you know, good for all commodities, I think, that theme. I can't believe I've spent most of my time on this already. I wanted to summarise what's happened with equities, and this is the mining bust which has taken place in the last 2 or 3 years. The key line there is the brown line, the ASX 100 Resources Index. That's sort of mildly gone off. That's guided by BHP and Rio, who have had the most mild bust of any of the majors. So looking at Australian indices for this is not particularly useful. If you looked at Glencore, Anglo, even Teck, they're off between 40 and 50% in 2 or 3 years. They all bottomed out in April. April was a dip. You can see that in the ASX 100 industrials on this, the orange line. And the same dip applied to the big resources companies. But the interesting thing is that the big resources companies broke out of their downtrend and started a bit of an uptrend. It's only a few months, so maybe it's a bit early to tell, but if I start putting some other things on that, it starts to make me wonder whether we've actually seen a reversal of sentiment at around April this year. I've plotted some resource microcaps as a group. I've plotted some gold juniors, and it's really just to show how are those two groups, the tiny explorers versus the golds of that part, how are they performing in that period of time? And they have started to lift, and that in itself, I think, is extraordinarily instructive. There's some notes there for when this becomes a handout or people want to print it, but I've put the big emoji hand of Homer Simpson on it to say, well, what was going on in April this year? And of course, Trump's Liberation Day was in early April. There was a lot of talk about tariffs. A lot of this applies to the price of commodities. And I think it's still very early to know how this is going to work through the market. But what it served to do was to put a lot of people's attention on what is going to happen with commodities. And when you sort of take something from obscurity, we've been too busy with tech, interest rates, everything. Oh, what about commodities? People go, oh, well, what about commodities? Start looking at it, and all of a sudden you've got money starting to change direction and think about things in a comparative basis for the first time in a while. So interesting how sentimental turning points can be accompanied with that. This bust has played out in liquidity. That's what drives it, money coming into the market or going out. And the best measure of that is IPOs. You can't list a new company without a strong market. So it stands to reason that at the top of the market you have a lot of IPOs, and at the bottom of the market it's really hard, so you have very few. What's interesting to me here is after a very obvious peak in 2021, and this is just quarterly numbers of exploration companies listing on ASX, in 2025 we actually had 2 new listings in the first half of the year. Now, neither of them were even really IPOs. One of them was a company that raised $600 as a compliance listing, and it hasn't traded since. Since mid-year, since June, there have been 8, it might even be 9 by now, IPOs, and most of those are above water. So they're trading at higher prices than they actually sold their shares in the IPO. So that's an incredibly strong indicator for me that liquidity has gone, well, we're going to stop. For the first half of the year, it was just a blank patch. But here we are with all of a sudden IPOs happening, and they've been quite successful. So if I put my micro caps and my gold stocks over the top of that, they've both started to kick up. Gold's clearly a bit earlier, but the resource micros picking themselves up as well around that turning point of April, which aligns itself with a couple of good months after that, and all of a sudden you start to have IPOs. So I can see that being quite instructive as well. I'm going to slip the Captain Obvious hat right back on to try and draw this to a close. There's the gold price since 2021. It's gone up. I think we all know that. Interestingly, it flattened in the last sort of 6 months. And when it flattened, the gold producers had a bit of a soft spot. So that's the ASX Gold Producers Index, if you like. There's a few non-producers in it, but mainly producers. Track the gold price. Gold price goes up, producers go up. Gold price goes sideways, producers soften a bit. Let's add my gold micros to that, or my gold juniors. Now, they took a lot longer to come to this party. There was a good period there of almost 2 years where the gold price was going up and they were still continuing to falter. So there was this anti-small cap sentiment, if you like. That was across the market. And I think that was driven by interest rates, because interest rates were reasonably high. That drives people towards larger stocks and lower risk. All of a sudden, interest rates coming down, great for gold. It's also great for small caps. So all of a sudden, you've got a couple of key tailwinds in the junior risk-on sector of the space that we look at. Great for golds. This is going to get people thinking about exploration again. Couple of successes on this page. People look to recycle those profits into things like tin or whatever else. So let me finish by just talking about the cycle and the clock. This is the most material influence on your investing experience in this space. If you invest at the top of the boom and then you hold your stocks, you're probably not going to have a great experience, no matter how good a company you pick, than if you'd pick them at the bottom. In 2021 and 22, we had the market top. We've had the full progression of the bust. We've had the majors down somewhere between 25 and 50%. The micro caps have fallen about 75. And then in 2025, we're somewhere around the bottom of that. 6 o'clock sharp is where the boom starts. It's going to feel mild to start with, but that's where it happens. So I'm not picking a turning point yet. I think we're very close to it. We might have passed it. It might still be in the future, but we are so exceptionally close. There was discussion yesterday on the gold price about, have we missed this? Is it too late? And my answer to that is, well, let's think about this as the ball analogy. If the invitation says the ball starts at 5 and it finishes at 11, if you get there at 5:30, you're not going to say to people, how many beers have you had? Because if you've had 2 beers, I'm not having anything. That's bullshit, isn't it? You turn up at the ball and you go, righto, I got to catch up. And the more I drink, the more I save, because the bar closes at 11. So what we've got to come in this cycle, there will be commodity price performance. There's going to be money coming into the market which has been out of the market, recycling out of high-priced banks, high-priced tech, and we're going to have new investors coming to the market. And this will be happening the whole time for the next few years as this cycle plays out. So it is not too late. You've got to the party when everybody's getting into gear, but the tequila shots aren't for a while yet. So just relax. This presentation is going to be online. I work for Lion Selection Group out of Melbourne. We invest in this space. If you want to know anything about Lion, if you want this presentation, please head to our website. That QR code will take you straight there. And if you have any questions, there's an info line there. You can shoot me a note as well. Thanks very much, folks. I think I've gone a little bit over, so I'm about to get bulldozed off stage. And I'm going to go and check out my nephew's new digger over there. But thanks very much for having me. I'll speak to you soon.